Good day to you. This is Owen McCafferty. Thank you very much. I am joining you again on a topic relating to partnerships, either de facto or implied, in a professional practice operating entity. And as usual, all these programs are brought to you through the kind sponsorship of Professional Fusion. When we talk about partnerships, a partnership is usually defined as an activity joining together two entities, usually people, and they are jointly and severally liable. What that means is that they assume all obligations, both taking the entire obligation as well as their pro rata part. So that means if one partner doesn't cooperate, they can go against another partner for that portion of what the non-cooperative partner is doing in the event of any sort of litigation or suit. So partnerships are not something that you really want to enter lightly. Next issue is in the American system of linguistics. We throw things around without really understanding what they mean. When two people say we are partners, that's a pretty serious issue because it then implies joint and several liability. So often a smart professional, be they in veterinary medicine, dentistry, dermatology, or any of the other professions, is very, very careful when they use the word partner. You often hear this with salespeople. Salespeople love to be partners with you. But when you ask them, well, does that mean that you're also going to be assuming the liability of that other party in the event that they don't pay? There's usually silence, coupled with the fact that there is lack of an educational competency that is eroding the skills in the United States today. So partnerships, be they implied or de facto, do assume a risk. Now, a partnership is followed for taxation under Subchapter K of the Internal Revenue Code 1986, which to me is like yesterday. But the Internal Revenue Code with a partnership establishes that each partner has a pass-through duty to recognize their pro rata share of income, credits, and expenses in accordance with the partnership agreement. So you would assume that a partnership agreement, if it's to be prudent, should be written. If there is no written partnership agreement, the usual assumption is that all items are considered to be recognized on a pro rata basis. That is the same basis as the equity ownership. So you may want to open up and look at your partnership agreement just to make sure that it is exactly what you intended it to be and that it's in writing. I strongly suggest that every 3 years you at least peruse your partnership agreement to make sure that the circumstances and the players are acting in accord with the intent of the previously written document. Just because someone writes that document doesn't mean that they understand the circumstances. You would assume that an author of a document would be calling you on a periodic basis and saying, has anything changed? Should we be amending something? De facto, I just don't see that happen often. In fact, often it's the accountant who does not have the right of statute to write a legal document that has to at least remind the clients that they should be picking up that document, reading it, and possibly taking it to a person who is licensed in the state, Commonwealth, or in Canada, province, and have the availability of amending it to the needs and the circumstances that exist at the time. Too often, we just let things slide. And then there's this grand epiphany when the need arises and someone all of a sudden says, oh my gosh, that's not really what we intended. So reading the document is really important. reading it aloud, or if you're going to have someone review it, insist that they sign off on the top left-hand corner of every page with their initials and the date, and then they mark each and every paragraph that they read. This establishes culpability on the part of the reviewer and forces that reviewer to take it seriously. Often people glance through a document and say that they've read it when in fact they really haven't given it the attention. The only reason I know that is that we do mark every page. We do make notes on every paragraph, and in fact, in some instances, every sentence. We believe that the people that are going to author a document, or those that amend it once it is authored, should be showing you that they've taken due and prudent consideration of how that document has been reviewed. Now let's look at what some of the tenets are. It's good to stress test your partnership agreement. Best way to stress test it is to look at those critical areas and see if the computations or the references are exactly what you thought they would be. One example I could think of is in the old days, let's say 15, 20 years ago, when people would write an agreement, they would assume and they would use the words fair market value as being a state of art, when in fact fair market value could be based upon an aggregation of consideration by a qualified evaluator of the income, cost, and market method, may be based on the modified cash method of accounting or income tax method, which are special purpose framework methods, or could be under generally accepted accounting principles, or for those of you that possibly may be outside the United States, the International Financial Reporting Standards. So a lot of the documents are silent because they are so old that they haven't really caught up with the accounting profession. Next issue is, what's the basis for the valuation? Is the basis for the valuation intrinsic worth, investment value, or strategic value? Those items have to be specified and laid out in the partnership agreement. Is there an example in the partnership agreement? Are there ratios and percentages that are used? Are there interest rates that are long ago not in accord with what is occurring today? You have to stress test these. Best way to do it is to give the accountant the document as it's finally written, either before or after the amendment by a qualified licensed attorney in the state or commonwealth, and go over their interpretation of what, based on their reading, the valuation methodology would be, the timing, the types of assets that would be included. Another example would be life insurance. If you have life insurance that is being carried on each individual partner, and no mention is made of how that asset is to be placed in the valuation model, is it to be used only for the funding of a buy-sell, or is it to be used as an asset? Because at the date of death, that becomes an asset that's not contingent, but de facto, an asset that is to be valued for purposes of the valuation model. So exclusion or inclusion of life insurance becomes a pretty important issue. There's a lot of nuance. The purpose of this narrative, which I've already gone over our target amount, requires a lot of effort. But just to urge you, please take the time, make the effort, and engage competent people to help you review the document at least every 3 years on a cursory basis, and on an in-depth basis every 5 years. So for Owen McCafferty, who I am, and for Professional Fusion, I would like to say thank you very much. This is a wonderful time that we've had together. Hopefully some of you will take this as an urging to go and look at that document that you think may be in the bottom right-hand drawer, dust it off, and see if that's still your intent. Until the next time, thank you very much.